Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Of course, it's seasonal time of the year, I should say. So the week ahead will be very short, really, but we have had so much or so many big risk events happen actually over the last week. So a lot of this webinar will be devoted to what's been happening in markets really. So we've had US CPI report, of course. We've had the multiple central bank meetings, including ECB, Bank of England, Bank of Japan. So we'll be reviewing all of those and then looking at just some investment bank expectations for stock markets, which we did look at last week, but we'll just go over again, and also some FX ideas as well, and what not central banks, investment banks are looking at for 2026. Here is the disclaimer, which I'm sure you've all read before, but I just need to show you again. And hopefully will be 30 minutes or so. We'll just check out how markets are trading currently. Obviously very quiet at the moment with holiday markets, but we have had, of course, gold and silver hit more record highs again today. Silver been hitting record highs over the last few weeks now. With a really a parabolic move, it should be said, and very, very overbought now. So some sort of correction we would expect to happen at some point soon. But gold was a laggard in some ways, and we'll just check out the charts shortly. As well as silver, but some interesting technical patterns actually for gold, which we've sort of highlighted on some of our dailies. So, now you've looked at the disclaimer. Yeah, here's what we hope to get through: mainly central bank meetings, a little bit of data out of the US, but not too much in the week ahead or so. So let's get straight to it. Here, I've already showed you this forecast actually, but just to reiterate this, just because it's quite interesting, really. I know that Bloomberg actually, the terminal now has is writing pieces about how consensus is very optimistic again for 2026, which is a little bit of a warning sign because everybody's optimistic, which is a kind of investment bank strategist thing, but still, it means there is ripe for potential disappointment, I guess. Yeah, average gains, as you can see from these nine investment banks, 10% or so. Gains, which would it would leave the S&P 500 7,500 by the end of 2026. As I say, roughly 10% gain. Most of these investment banks, nine of these investment banks, that's the average of their forecast. And that would be slightly less than what we have had seen, of course, this year. But Yes, a little bit higher than the long-term average, which is sort of 7, 8% or so, 8%, I think. So interesting, obviously, that we've had AI valuations and the AI bubble question being asked a lot in the last few weeks, and that has caused a rally. So, yeah, that's investment banks generally. Also, I said we'd look at FX as well. This is an interesting graphic. If you just read this, so these are investment banks along the top, really. Big main investment banks: JP Morgan, HSBC, Citigroup, Bank of America, et cetera, et cetera. And then you've got the different major currency pairs, the G10 currencies, basically. And then you've got whether they're positive or negative through 2026. A very quick summary, really, but basic summary, but gives you quite a good guide. So everybody loves the Aussie, for example, all green across the top. Whereas, say, what else? Love the Swiss krona. And then, as I say, these banks sort of views tend to match sort of speculative views around the turn of the year, actually. So it's sort of probably not wouldn't be a surprise to see the Aussie, the krona in demand into New Year as central banks basically hedge funds rebalance out of things they don't like and into things they want to own for 2026. And very often, the most popular trades for the new year start working around now, and then they stop work. They stop working, I should say, towards the sort of end of January once the big money has been deployed. Obviously, then if retail get involved as well, not such big volumes, of course, but just an interesting sort of idea as we see the Aussie dollar actually up over 0.5% today. And then on the flip side, you've just got some of the unloved currencies. So sterling, you can see how many banks are there? 12 investment banks, and you can see sterling. Um, yeah, only three of those nine are bullish. Um, uh, no, three of the 12, sorry, are bullish, so nine are bearish on sterling, for example. Euro not so much loved, quite mixed. The yen relatively mixed as well. So yeah, just a guide for you on what some of the investment banks are putting out there and their views on some of these on the major G10 currencies. Markets otherwise, APAC stocks, they kicked off the week with gains across the board, really on the back of stateside strength. The US closed, sorry, on Friday, of course. Tech outperformance continued across the region. We've had some geopolitics actually with, of course, US Coast Guards tracking two oil tankers in international waters close to Venezuela, marking three tankers within the past week now. So that's been a sort of seen a safe haven bid really in gold by all accounts. And got oil is up not massively, around 1% it was earlier. Russia's Kremlin, they said changes made by Ukrainians and Europeans to peace proposals did not bring agreements closer or add anything positive. That's a recent headline. And otherwise, European equities are, well, they're slightly softer actually, with Eurostox 50 down around 0.1% or so. That's after the cash closed up 0.3% on Friday. Let's just talk about gold actually then. Let me just pull up a chart first of all. I should say as well, I always forget, apologies. Everybody who listens in, though, please, if you do have any questions, please do ask them along the way. More than happy to answer or try to answer anything you're looking at or anything we're talking about. So please do ask any questions. Here is the gold chart that you can see. And gold really, yeah, kicking off, gold kicking through to all-time highs again today, capping off a quite incredible run up. Um, well, it's up over 70%, I think now, year to date. It's doubled in less than 2 years, gold. And really, we've written about it extensively, really, in some of our daily commentary in the week ahead, as well as some of the month reviews, actually, as well, which we put out. But of course, there's the sort of usual factors behind this. So just to repeat those, really, central bank buying, of course, has been big. Fed rate cuts, of course, and Fed rate cut expectations, a falling dollar, Fed independence concerns. We've seen strong ETF buying. That's now near all-time highs. And then we've got as well additional factors with the new Fed chair, of course, being in focus as well. Potentially that appointment or that announcement for the new Fed chair will be in early January. And potentially, if that is a dove, then we will see more rate cuts by the Fed. And that certainly could boost gold going forward, precious metals generally, non-yielding assets, of course. So lower interest rates make those assets more appealing. And it's interesting, really. We sort of hit 3,000. You can see here um, uh, in April, basically. You can see that big move higher through 3,000 post Liberation Day, of course. And then we hit 4,000, you can see here, through the US government shutdown. So some notable sort of round numbers and notable events taking us through these round numbers, really. just on central bank buying, just for your guide as well. So Q3, that saw increased central bank buying after 2 quarters of falling purchases, actually. 28% seen in Q3, the increase, or 28% more than Q2, sorry. And that was 6% more than the 5 year average, all seen in Q3. So central bank buying has been a massive sort of underpinning of support of gold. Um, of course, that is really down to concerns from countries about sort of Russia-style sanctions on foreign assets, and indeed the pace of annual purchases by central banks has doubled since the onset of the Ukraine-Russia war. Um, so that's been a huge factor, really, for gold, and is likely to continue through 2026 as well. And then this expectation of Fed rate cuts, of course, as well, will or should underpin support again. And then we have this sort of wider theme about debasement and dollar de-dollarization. That is a debasement trade is essentially around worries around the fiscal deficits, global fiscal deficits, but especially the US. Um, and yeah, we've seen or should see a continued bid. That is the expectation. I guess one thing that sort of worries us is essentially that we haven't found anybody bearish gold, which is can be a concern for sure. Um, and potentially then we have seen some sort of pullbacks when markets have had the jitters or markets sell off, stock markets, and then investors have to dump gold essentially to raise cash and to potentially pay for margin calls as well. So just watch that that's going forward. But otherwise, a lot of factors in gold's favor. You can see really interesting. I think this is the weekly chart, and you can just see some symmetrical triangles basically. If I just pull up this other chart. Actually, I'll leave it with this for the minute, the weekly. So, yeah, just symmetrical triangle charts, patterns, sorry, triangles, which are bullish continuation patterns essentially. And you can just see prices going higher, but they are capped at a certain level, and then they just break through with all the buying pressure. And you can see that when we went through sort of 3,500, and then quite a nice shorter term one through sort of October, November, and we were then hovering just below or breaking through to a 43.80, and then above that today. Here's the daily chart. And again, you can see that sort of triangle pattern, continuation, bullish continuation pattern, which we then drifted up through to the record high, that 43.80 level, and then burst through it today. So multiple reasons for gold and silver going higher. If I just show you the silver chart just quickly, as I said, sort of parabolic move, really. We're up 2.75% again. You can just see this move after this upside break in late November. Again, quite nice sort of patterns here, bullish consolidation before breaks higher. But then we have gone sort of very, very sharply higher. You can just see overbought on the daily. We're overbought on the weekly somewhat, and we're overbought on the monthly after 8 straight months of gains in silver. So at some point, we would technically you expect a pullback at some point. Um, okay, that's gold and silver. Just stock wise, just let's pull up a couple of charts. Because we're lagging, of course, we did get a decent bounce. So we held that sort of 50-day moving average. This is the S&P 500, 67 now, that 50-day moving average. And we just bounced off that, having dipped through it briefly just for the day. So we've got all-time highs really in the S&P 500, 69.20. We're going to the sort of Santa rally. Really, it's a rally in the last few days of the year, and start of the new year. Sorry, so the last few days of this year and then the start of next year is the actual specific real sort of year-end rally, really, although it's known as a Santa rally, of course. We're kind of potentially set up for that. We've got futures up around 0.37% or so in the S&P, so we're very close to hitting record highs potentially. And with, as I say, that year-end rally, then that could well happen. Nasdaq then similar to the S&P 50-day moving average at 25,211, all-time high at 26,182. Still have these highs here from sort of early December at around 25,870 just to negotiate. And then the Dow, you can see the previous high. Actually, I need to move that. Apologies, but that was at 48,431. And now the recent high is at 48,886. So just sort of hovering around here. And potentially then I'm just seeing futures slightly positive, modestly positive on the Dow, more so tech. So we're getting tech gains into year end, which potentially leads us higher. Okay, let's move on then to last week's main events. A lot of big events, risk events here. So that's why I want to concentrate on these. So first up, we had US inflation data. I've just got a graphic here with all the main numbers. Clear downside surprise in this data, softer than markets expected, really, and especially given worries around tariffs and rising insurance costs. It was an interesting print. We didn't get a month-on-month print, and no October survey due to the government's shutdown. So the year-on-year numbers, well, they told us a clear picture, really, if you read the numbers. So headline inflation, that slowed to 2.73% in September, well below the consensus focus for 3.1. Core inflation, that then strips out volatile food and energy costs, that fell even more sharply, so to 2.6 from 3% previously and 3% expected. In fact, the core print was zero point 0.2 percentage points below the lowest forecast submitted to Bloomberg. So a really, really big miss. And if you put that into context, that data implies prices only rose about 0.2% across October and November combined versus expectations closer to double that. Just on the component side, just for your guide, before I sort of talk about a big caveat, of course, several components, they help drive the slowdown. So we had food inflation easing, grocery prices cooled sharply, used car inflation fell despite higher auction prices, actually, and housing costs slowed as well. Core goods inflation, that also edged lower, which is a positive sign given tariffs, of course. But then energy prices ticked up slightly with gasoline now, well, below $3, but that pressure looks temporary. The caveat to this, of course, and that is the big caveat, and it was interesting, the market reaction, really, which was really very muted compared to what would happen if this was a genuine miss, is of course that there was a lot of skepticism about the data, about the big misses, because data collection was disrupted due to the US government shutdown. So really, markets look through this, as I say, and really we will want confirmation from the December's report, really, and probably January's as well, that this sort of disinflation process is taking place over a longer period. Interestingly, though, yeah, so markets fairly muted after this big miss, which was, yeah, down to a lot of skepticism. But then we have to remember Fed Chair Powell, even last week, was sounding very relaxed on inflation. And if wages continue to cool, rents keep easing, and then fuel prices stay relatively low, then inflation could head back towards 2%. Remember, on month number, we need a figure of 0.17, so just below zero point 0.2 over a number of months to then bring down that headline figure towards the Fed's target of 2%. So really a lot of, yeah, as I say, skepticism. We're waiting for the next numbers over probably a few months to see whether this trend is real or not. Okay, that was CPI data. Then we did have, of course, ECB, the ECB meetings as well. Um, Bank of England and Bank of Japan. Let's just cut to the ECB meeting first of all. I'll just pull up euro dollar chart actually. So bear with me 1 second. Sorry, 1 second. Yeah, bear with me. Sorry, guys. Right, hopefully you guys can see that euro dollar chart. Yep, you should be able to now. Yep, so ECB meeting obviously last week, pretty much as expected, kind of hawkish hold really. They haven't cut rates since June. Nothing was expected. And then, well, after more than 6 months actually on hold now, the message pretty much loud and clear. So really would take a major deterioration in growth or inflation to get rate cuts back on the table. ECB policy is in a good place. We all highlighted this last week, actually. Really, we're just in neutral policy now. So, policymakers comfortable sitting here. President Lagarde, she reinforced that view in the press conference. So while the outlook is surrounded by modest uncertainty, really, she described conditions as broadly benign and stressed optionality at future meetings. Really, there's no bias. So cuts, hikes, or staying put are all possible, of course. And a kind of little bit of a walk back, really, from earlier comments suggesting the next move could be a hike. Wait and see, really, is what we got, and especially as well in the quarterly staff economic forecast, the economic projections that we got. So they sort of explain that confidence, really. Eurozone growth forecast of 1.2%, rising to 1.4 in 27 and 28. And then fiscal support should boost momentum in 2026 as well. And then inflation, that's projected at 1.6 next year, 1.8 2027, 2% 2028. And actually, if you dig into that, it's actually even calmer in a way. So inflation runs below 2% through late 2026 and all of 2027 before then ticking up slightly due to new EU carbon pricing rules. So, sort of ironic, the ECB forecast deliver exactly what its old definition of price stability aimed for, actually. But the bottom line for markets, inflation near target, growth close to potential, then there's no urgency to move rates in either direction. And for now, neutrality, that really rules, really, and we shouldn't really expect any fireworks anytime soon. A little bit annoying for volatility, of course, and if we're trading, and you could just see that we did get, yeah, we're just trading sideways actually at the moment, below 118. We got up to 118.04 last week. Last Tuesday, of course, ECB meeting, nothing much happening, price action wise, I mean. We're just holding around here. So 118.04, sort of near term resistance. Support probably not coming down till or next major point is support. 100-day moving average is at 116.54, 50-day at 116.18. So that's ECB. Let's just go to then the Bank of England and just give you that chart. I did show you this last week, but still of use with where the inflation target is, of course, where inflation is currently, and then the benchmark, of course. And this was obviously just before they cut rates. So, yeah, we got a sort of hawkish cut, if you like, from the Bank of England. Heading into the meeting, we were sort of primed for a dovish pivot in a way. Job data had softened, wage growth falling fast, really, and that latest inflation print was easing quite dramatically. But they were all classic ingredients, of course, for a sort of softer message. But in the end, we did get a little bit of a surprise. So rates were cut to 3.75% as expected, but the guidance around future moves was noticeably more hawkish. So officials said upside inflation risks are now actually less pronounced, but warning that upcoming decisions will be a closer call as rates approach neutral. So that sort of closer call was relatively hawkish. Um, and the neutral rate, just for your guide, is probably sitting around 3 to 3.5%. So we're not far off that now. The vote split really continues to show how divided the committee is. So five members, including Bailey, of course, he backed the cut, and that was what pushed the Bank of England into that cut. But then, of course, we had four hawks voting to hold. Both camps, for your guide, just point to surveys showing wage growth expectations have stabilized around 3.5–4%. That suggests actual wage growth may not fall much further. And really, then that keeps inflation worries slightly alive. And that's what markets cottoned onto, really. And it's interesting, actually. Catherine Mann, a hawk, calling for her vote against a cut, was finely balanced, helped by the autumn budget measures expected to drag inflation lower. Really, sort of not a massive game changer, but modestly more hawkish than expected. Bank of England still looks set to cut probably two times next year, and that would then take the bank rate squarely into sort of neutral territory, 3.25%. That would be then February a possibility, but then March is probably more baked in by markets now. Um, and if we just pull up the cable charts of sterling against the dollar, just bear with me. Um, we have seen sort of choppy price action, really. A little bit down to the dollar as well. But we were trading around 134, you can see there, and held up by these long-term moving averages. So the grey line's the 100-day moving average, that's at 133.63. Black line is the 200-day moving average at 133.52. So they look like decent support, actually, and we've been just finding, yeah, bouncing off those, really, and potentially then if we could take out last week's high at 134.55, then we can get up to sort of the 61.8 retrace level of this move from that July high down to the November low. That 61.8 at 134.88, and then a minor fib level at 136.19. That is in cable. Next up, let's just get to the Bank of Japan then. And again, that's chart we've got, but just before, of course, the Bank of Japan meeting, but always interesting with obviously inflation data just to see that. So the Bank of Japan, yeah, they hiked by 25 basis points, very much as expected. So that takes the benchmark interest rate up to 0.75%. And well, rate setters, they expect companies to keep raising pay and said the cycle of higher wages and prices should continue even after this latest rate hike. Real borrowing costs are still well below zero, so money remains cheap and supportive for the economy. The bank then hinted that more rate hikes are likely over time, but the key thing really was that Governor Ueda, after the statement, he avoided numbers and stressed that any move will depend on how the economy, jobs, and company finances, of course, react to higher rates. So the fact he avoided numbers really was key, cautious stance by Ueda really on the rate outlook, especially at his press conference, and that undercut the yen really and market pricing for a follow-up move. later. Well, not until later next year at the earliest. Point. Yes, the 10-year yield that pushed above 2% for the first time since 1999. So that got a lot of headlines. And US Japan spread, so interest rate differentials, if you like they have narrowed to the smallest gap since actually they narrowed to the smallest gap since 2022. But the yen that did drop sharply, really, dollar yen going higher then. Um, Probably down to market positioning because uh, most banks, most speculators set up for a slightly hawkish Bank of Japan meeting, really, and Governor Ueda, but he, as I said, batted against that. Um, so with this fall in the yen, rise in dollar yen, although I'll just show you the chart shortly, then potentially you have to watch out for urgent warnings from Japanese monetary officials about dollar yen being too high. Going forward, just before I get to that dollar yen chart, the Bank of Japan will be watching inflation, of course. Overall, inflation may dip below 2% in 2026, but underlying price pressures should remain clearly above 2%. Then watch out for wages, of course. Unions are again pushing for strong pay rises. That points to steady wage growth. And then the yen, of course, is important to watch. If the yen strengthens, the bank can wait. But of course, if it weakens, that then pushes import prices higher, and it may mean they have to hike sooner. For now, though, the yen stays soft, and that's helped by investors using it for carry trades, of course. But then cheaper hedging costs and lower energy prices could support a stronger yen next year. If we just pull up the chart, then you can just see that big move higher here in dollar yen. So yen weakening dramatically, and now we're just um, trading just below that high from late November, 157.89. If I just pull it back a touch, you can just see that high from January of this year, actually 158.87, and then the big move lower. So, as I say, we're still up there, still very close to those sort of long term levels. Potentially, then watch out for monetary policy, if not monetary, sorry, Ministry of Finance officials, and some sort of verbal intervention, if not more. Interesting whether they do something when liquidity is lower and they get more bang for their buck, if you like. But I know some Japanese analysts have been stressing that potentially doing it with US data as well, which weakens the dollar, is or has been a sort of modus operandi, if you like, for MOF officials before. So, sort of thin liquidity, US data helping, then gives a sort of double bang for their buck, if you like. So yeah, bottom line, just briefly then for Bank of Japan, expected a hawkish hike, didn't really get that. And we wanted sort of clarification on the neutral range and the future rate hike path. Of course, we didn't get that. Ueda remained quite vague, and that disappointed markets, and we got that big jump higher. We also got the crosses as well: Euro yen, Swiss yen, sterling yen, all breaking to all-time highs, I think, and will be interesting to see that going forward, whether that trend continues. The key line, though, from Ueda, the Bank of Japan would need to check the impact of rate change each time before moving again. And this year, of course, it took the Bank of Japan 11 months to monitor the impact of January's hike, if you like. So, yeah, just a couple of thoughts on that going forward. Okay, that was all the main events from last week. Just bear with me 1 second. Right. Hopefully you can see that. Apologies, a few issues here, technical issues, but otherwise, yeah, just bits of data for the next few days. We do get the RBA minutes. Could potentially be interesting as a press conference. If you remember, revealed quite a hawkish Governor Bullock, who said the board discussed circumstances in which rate hikes might be required. Um, Still concerns around persistent inflation, and they've pushed markets into expecting now, well, no more policy easing and potentially hikes next year. We talked about this last week, being of interest, really, with a couple of central banks now talking about, well, stopping policy easing at least, and then moving into sort of a different phase now, policy hiking. Just pulling up the Aussie dollar chart, you can see here. As I remember, the investment banks favouring the Aussie dollar for sure. And you can just see we said about playing the range, Richard, really, which was sort of 64 to 66 ish, and then we've popped up briefly out of that to the top side. But here, potentially, then, if 64, sorry, 66 is a zone now of support. Now we've broken it. We're just pushing higher. Then potentially 67.21 is a fib level, minor fib level. Um, Sorry about this. And then you've got that mid-September high at 66.59 as well, potentially. So interesting whether, yeah, we do hold 66 as support and now we create a new sort of range trade or potentially something beyond that if we can break through sort of 67 or so in the Aussie dollar. We do get US GDP as well. Growth expected to slow from the prior 3.8%, but GDP should remain still above a healthy 3%, it should be said. Could prompt questions, of course, around why the Fed cut rates again for a third consecutive time. And with inflation, of course, stuck around 2%. Let's finish up with the dollar chart then. You can just see here, pretty quiet, of course. We've got the 200-day moving average. Sorry about this. 200-day moving average. The black line at 99.57. Sorry, 99.18, and also then the 50-day, which is actually trading on the same level, 99.18 as well. Interesting whether we dip above. If the 50-day goes above, then that's bullish golden cross, or not. That would be interesting. So support around 98, and of course the long-term low at 96.21. Okay, I will wrap it up there. That's been 37 minutes. Yeah, please do follow us on social media. I really do appreciate you guys being on the call, of course. As always, we do have one more final webinar, same time next week, actually. So please do tune into that. Won't be a lot of market stuff or current market stuff to look at. So we'll just run through, I think, probably all the charts, technicals, really, looking at all the indices, stock indices. We'll look at gold and silver again, and then all the currency pairs, really, as well as a quick review of what's been happening and what a preview as well of what to look for going forward. We'll be busy in the following week, of course, with the US non-farm payrolls report on that sort of second Friday, if you like, of the year, which will be the 9th. So nothing on the 2nd. I think it's the 9th of January will be the non-farm payrolls to look forward to. Okay, do take care out there. Season's greetings to you all, and we'll speak to you hopefully same time next week.